Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go back to Twitter. We got a lot to talk about. Banks, liquidity, how this system kind of operates. I'm going to give you my financial opinion about all of it after I read a bunch of these other financial opinions. Again, if you need any help with anything in this commodity bull market that is still in progress and coming in the future, sign up finding-value.com. Become a platinum member. We've got a platinum question and answer session at 5 p.m. Mountain Standard Time today if you would like to join. Use the word discount in the coupon code. So let's go through here. I've got a lot of opinions I'd like to share around a lot of different things. So, and again, if you want to follow me, it's at finding_finance on Twitter if that's what you want to do. So Lynn says, the recent liquidity drain is adding fuel to this trend and incentivizing deposits to flow away from small banks to the big banks. You know, I want to remind everybody, the small banks, there's a lot of small banks that failed in 2008, and they were all absorbed by the larger banks. The larger banks are part of the central banks, and they got bailed out. Interesting stuff there, right? There's no conflict of interest in that arc of a story I just said there. It says the Fed's QT since 2022 sucked cash reserves out of small banks more quickly than large banks this time. Small banks are already back at cash ratios they reached during the 2019 repo spike, while large banks aren't yet. So this is your 2019. These are the small banks, cash percent of total assets. Same with the large banks. And the large banks have a larger percent of total. They have a larger cash position as a percent of total assets than the small banks. If these guys fail, these guys are going to soak up these small banks' assets just like they did in the last crash of 08-09. Totally unjust in my opinion, but that is probably what is happening to some extent here. Keep scrolling down. It says a truly incredible graph, and we've talked about this a lot. It says the U.S. will become the world's largest liquefied natural gas exporter this year. Liquefaction capacity in million tons per year. Look at the United States going forward. From 2022, we drastically ramp our liquefied natural gas exporting capabilities from 2024 onward. Now, there is some debate or a challenge out here that some articles have come about. Goring and Rosenzweig, they talk about natural gas and the production and supply of natural gas in America. They believe that some of these fields are, we'll say they're maturing. We're hitting certain areas in terms of percent of tier 1 wells where we're going to hit over the next few years. We may not be able to export that amount of natural gas because our fields are not capable of producing that amount of natural gas. Now, that is one opinion. I have no reason to not believe that opinion to be correct. And that could be a potential problem. So we have all this exporting capability coming online. And if we don't have the natural gas to ship around the world, that's going to drive LNG prices higher and higher and higher. And we will converge to world pricing for liquefied natural gas and natural gas in America. They also predict that to happen. So if there's any sort of supply problem that arises during this time frame, the entire world, I think, will have a much closer natural gas price than we do today and before. So everything's kind of converging price-wise, and the world natural gas pricing is much higher than Henry Hub. Therefore, in my opinion, and Canada is also going to have some exporting capacity, and they also ship their natural gas to America through pipelines. I think natural gas in Canada will get repriced the most of probably any country in the world. there's your opportunity. And I have laid down some massive bets on that occurring over the next 5+ years. And the reason I say I'm looking at this from a long-term perspective is the chart we're looking at right in front of us. It's the exporting capacity that's coming on in the United States, and it's the tier 1 wells that are drying up in America in the shale areas, which means that the last great, I'll call it the last great exporting capacity in the world for oil and natural gas, in my opinion, is probably in Canada. And if you take a fine-tooth comb, run through all the charts, you can find large accumulation Livermore cylinders in those companies that have gigantic fractals. Gigantic fractals are fractals that are created by humans. And the size of the fractals are potentially how big they can move to the upside. Now, there's also some small caps that are, we'll call it swing producers, high cost producers. If something like this happens, they're going to go crazy to the upside. Problem is, short term, we're going to ride through some volatility, guys. Short term is going to be highly volatile. We've got, because of what I just went over here, the liquidity coming out of the system here, the recent liquidity drain. And the drain here is going to cause problems in some of these banks. And is there a contagion? Probably, because people are going to get scared and they're going to yank money out of other banks potentially, which then will lead to money printing. And guess what? That money printing is going to be seen as inflation. And as inflation comes and moves around the system again, that's going to create the end of wave 2 and our pullback in the beginning of wave 3. So that is kind of how it's all tied together. And that's humans interacting with each other and the markets. Now, when that money comes into the system, and if there is a constraint in oil, we're going way higher, baby. That is what I've been invested for. Because that money, it's going to, you have to, so if money comes into the system, and let me back up here real quick. The system is surviving off of inflation. The system can only survive on inflation. You cannot have a long-term deflationary outcome. It will crash everything. And why would it crash everything? People will not be able to pay off their debt. The physical money does not exist in the system because the system is so leveraged up. The reason this is declining is because liquidity is coming out of the system and all of the debt that is fictitiously created stays there. That means that debt can't be paid off. If the debt can't be paid off, it is a deflationary type problem. The problem is deflation hits everything. It hits the revenues of the federal government. It hits the revenues of the state government. It hits the revenues of everyone who collects taxes. Because if your system or credit starts to collapse and prices collapse, how do you tax capital gains on stuff that goes down? You can't. How do you tax a house price that goes down? Oh, wait, their property taxes go down. Everything goes down in a deflationary type problem. So you can't have deflation because everything goes bankrupt. The state goes bankrupt. The pensions go bankrupt. Everything, it all goes down. You can just So what do you think they're going to do? Print money, have inflation. And they should wear a hat, make inflation great again. Because that's what's going to happen. And we can see the liquidity coming out of the banks causing problems. Do you think that they are going to leave the banks with a problem? No, they're going to kill the small banks. They're going to assimilate the small bank's assets into the large bank assets, print money, throw it into the system, and then the system will thrive again with all that newfound credit and whatever else you want to call it, stimulus, coming back in the system. It says the U.S. banking system's on the verge of a much bigger collapse than 2008. Banks own long-term paper at extremely low interest rates. They can't compete with short-term treasuries. Mass withdrawals from depositors seeking higher yields will result in a wave of bank failures. And that's exactly true because of the liquidity being drained out of the system and the herd is humans interacting with each other under certain market conditions. I talk about this a lot on the website. The patterns and the technical patterns that we are looking at in the charts are created by humans interacting with each other under certain market conditions. What have we seen and what have I shown on this channel for all these different years? I'm saying we have a commodity bull market that's coming. Precious metals look great. Energy looks great. All of these things look fantastic. Why do they look fantastic? Because the conditions that are coming are going to favor those assets. The smart money is accumulating it, and we can see that in the technical chart patterns. We're seeing that accumulation. Now, what happens if we get a banking collapse or a threat of a banking collapse? What do you think the herd is going to do? They're going to yank their money out of banks, right? Okay, so where's that money going to go? How are they going to preserve it? They're either going to hold it in cash or they're going to have to move it to something else. Now, here's my thing. If the banks have a problem, what do you think the Federal Reserve is going to do under those conditions? So it just, the beginning of the fear of people yanking cash is going to start a chain of events. Those chain of events are going to happen. And I think what will happen is it will lead to a reliquification of the banks again, if it gets to that extent, depending on which banks get impacted. Now, if they reflate, what happens if you put money into the system? People have cash on the sidelines. They're going to have to do something with their cash, because if they do a big fat, amount of reflation, that's going to be inflationary. So the safest spot to be, in my opinion, is to be in the things that hold their value and have value, which is commodities and precious metals. Like I've said this entire time. Now, here's the problem. When the money comes into the system, and if you have a shortage in ding, 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 natural gas, oil, and energy, and remember, guys, Russia knows this. China knows this. So if they know this, what's going to happen? If you have a problem in oil, your GDP can't grow as fast. And if you have a decline in oil, the actual production of oil, you're screwed. So I think Russia timed this very well. And if they dump their treasuries too, you're going to see an increase in interest rates. It's going to bankrupt. It's going to be rough. I don't know if it'll bankrupt, but it's going to put a lot of inflationary pressure into the system, because you're going to run massive deficits with the interest rates being so high. And then they're going to eventually have to do QE and all this other stuff. Eventually. And the banks are going to eat it here because of the liquidity in the system. Sounds to me like we could see a reversal in the Federal Reserve stance here. It says, let's step back from the daily froth and consider the super cycle. We are still in a secular bull market. The short answer is, I don't know. And he's talking about the super cycle of stocks. The S&P 500 inflation adjusted total return. Do you know is that the stock market is sitting right on top of its 150-year trend line? There it is on top of the 150-year trend line. That is Fidelity. We come on down into, let me go into this thread real quick. It says, measured from the start of past secular bull markets, 20 to 40s and 82 to 2000, we haven't really deviated yet in any meaningful way. It says, however, the CAPE model is your price to earnings ratio, which holds that the trailing 10-year cyclical adjusted PE ratio is correlated to the forward. We can skip through this. Oh, here we go. That would suggest that the overall uptrend will continue, at least in nominal terms, but that it could be less robust than it has been. It makes me think of the late 1960s. 100% agree with that. This is the COVID bubble. You can see how this thing is moving, and we can see it kind of flatten out as inflation kicks up. I agree. It says, I believe the secular rotation is at hand between value and growth, small and large, commodities and financial assets, and international versus U.S. equities. All these pairs trades tend to work during regimes in which inflation is high and equity valuations are falling. 100% agree there. It says if the rotation from last year's valuation resets ends up being secular as well as cyclical. It suggests a long runway for all the flavors that were out of favor during the past decade or so, a regime shift of secular proportions. That is exactly what I'm talking about. Commodities outperforming to the upside. Here's your downside. You can see at 0, and now we're starting to move on up. Of epic proportions are coming. Value is going to go up and outperform 99, 2020. He basically how he's aligning this, and I talked about it before, is he's aligning this with the way that I aligned it, which is early in the bull market. We're just starting to come up, given the commodity to S&P 500 ratio. So we're starting a new secular. Secular means 10 plus years of a gigantic trend that is changing. And right now we can see all of the alignment in the charts. We can see the alignment even in the liquidity being drawn down here, and then probably having to reverse the stance and throw money back in the system. When they throw that money back in the system, this is the market conditions that are going to work. Commodities, international equity, like emerging markets and stuff, and value. Those are all interconnected. So we've got this market looks like an accident waiting to happen. And when I say accident, I mean the financial sector is poised for a massive paint-shitting, meltdown, your legs sort of event. Bankers got to be warning all their Federal Reserve buddies that they can't take much more. And again, when they put that money back into the system, it's going to fuel commodities. And that's what we're waiting for. That's going to be the Wave 3 event. It says platform supply vessels, PSVs, are ships designed to supply offshore oil and gas platforms. No one is talking about it, but their rates are ripping higher. Tidewater just acquired Solstead Offshore's entire PSV fleet of 37 vessels. And you can see the rates are starting to move higher. Offshore is where we are going to hit next for oil. We're going to hit it like mad. I don't think onshore is going to do very well in terms of oil production. It's going to do very well for onshore drilling companies. They're going to drill like heck to get a lot less oil. Put it that way. It says, curious that in the midst of all this drama, JPMA becomes a gold GLD custodian in 2022, after GLD had been in existence for 18 years, and B is aggressively adding to JPM's GLD bar list. It says Friday GLD update. Big moves today. GLD lost tonnage this week, but today, custodian JPM added 25 pages to the bar list, bringing their total to a new all-time high over 65 tons. They're adding gold. And you know what? I think that is a smart move. Now, here's something on the oil side. I talk about credit creation, a reliquefaction potentially coming in the future, and the banks having problems and liquidity drying up and some issues there. Now, this guy, Scott Sheffield, he's the CEO of Pioneer. He says, U.S. won't reach new record oil production ever again, says Pioneer CEO. That is a problem. We were the majority of the growth in this system of oil production. And he's saying, look, we're not going to reach a new record here in oil production ever again. It's coming, guys. We're going to see just how tight the oil markets are going to get in this world. Energy is the lifeblood of GDP. And if GDP can't expand and money comes into the system, it's going to be highly inflationary. It says long precious metals, energy, commodities, both stock and physical ETFs, these things will rip higher every time the central banks and governments step in to reliquefy the economy. That is what he knows. He knows that we've got a problem in all of these commodities and in oil. Every time they hit to reliquefy it, guess what happens? Inflation. And commodities and energy and physical and precious metals are going to rip. I hold the same exact opinion as Kevin does. And I've been saying it for the past couple of years on this channel. It says in 1971, there were 13,612 banks in the United States with all of those branches. In 2021, there were just 4,237 banks with those amount of branches. And the top 10 banks hold about half of all the bank assets. Consolidation towards the top. They continue to rip into these small banks, and then the big banks take and absorb those good assets. And this is how they're going to absorb them over time. Citigroup, JP Morgan Chase, Bank of America, Wells Fargo. And guess who owns these banks? They are all part owners of the central bank. Yay! There's nothing going on here, guys. They're not doing this on purpose. No way. Now here's 2023 finally got interesting. Jay Powell, right? Financial crisis or inflation. He's going to hit the inflation button. What happens when you hit inflation? Oh, look, we don't have the oil to support it. GDP can't grow. Major inflation coming. Now here's Cuppy. It says, it's important to remind everyone that woke stops working past 4% rates. It's almost as if 4% forces people back into the real world. It says, you're telling me that these venture capitalist clowns are now kneeling on their yoga mats praying that this house of Ponzi that they spent the last decade milking should get bailed out by the same folks that they've been dumping their excrements on? It says, so when does it count as the Fed having broken something? Brutal bank run accelerating. 2 more West Coast banks being hammered. Also note that Charles Schwab is down 20% this week. As I noted yesterday, there's never just one cockroach. And keep in mind, guys, I don't know what happens if something happens to one of these, brokerages. That's why I've got like 6 or 7 different brokerage accounts, and I've got a bunch of physical precious metals because it's like, get me out of this system. It says the 2-year is down 44 bips over the last 2 days since Wednesday's close. Only 4 other days in the last 40 years have seen larger 2-day moves. Let's see this. So we've got the day after the largest stock market crash in history, 1987, had moves the 2-year down that amount. 2 days after 9/11 terror attack, the day Lehman failed, 2 days after failed TARP vote. Says these are all epically important days in market history. Is today really in their league? Question mark. Now here's the commodities to S&P 500. This is the ratio. We are way down here in no man's land, and I do think that this is a double bottom that's about to happen and is going to break much, much higher to the upside. What this is telling us is that commodities are vastly underpriced in relationship to financial stocks, even to financial assets in general. And we could see an epic commodity bull market coming, a super cycle, still intact. Now, everyone's going to be afraid in the short term. I understand, guys. You're afraid in the short term and things could happen. I get it. But that doesn't stop the structural underlying problems in the market. I don't think there's a single thing that can stop this from happening. It can delay it. It can move it in the future. We could see short-term pullbacks. I completely agree with everything there. I don't know the future and the path that it's going to take. But I don't think you can solve the supply problems in any period of time. It's going to need higher prices. It's going to be inflationary. And if they print any sort of money for this system, which they're going to have to, it's going to all divert towards commodities, in my opinion. But it doesn't mean that will happen immediately. Doesn't mean it's going to happen tomorrow, or it's going to happen in 1 month or 2 months from now. That could happen in a year or two from now, or it could happen immediately if they decide to, to reflate the economy. Now here's North Star. He's saying Bank of America. This does look like a really crappy chart. We fell off this uptrend here, and it's doing a double top. This is much like Bitcoin's top. So sometimes the top hits here, sometimes it goes above it, sometimes goes just even with it. But this, to me, does look like a double top, and it could potentially break to the downside. Bank of America is a big bank. If something like this were to happen, we could see more liquidity come back into the system by the Federal Reserve. Now, Cuppy says, sometime soon, Jay Powell is going to have to make a hard choice. Will he keep fighting inflation, or will he save the banking system? We all know what he'll choose. That's when Project Zimbabwe restarts. As investors, the key is to survive the carnage until then. Stay safe. Project Zimbabwe, it just means massive inflation. He is going to choose inflation to save the banking system. Now, when that inflation comes in the system, it's going to rotate towards commodities because that's the market conditions that we have under us. That is the structural problems in the market. They're in commodities. And if commodities can't grow, your GDP can't grow. So that's where the money is going to rotate and fix. Here's another one. It says it's very close, but after updating for February, Biden maintains a narrow lead on having the greatest deficit this far into his presidency. But guess what? This has to happen. This system, in order to survive, you have to continue to hit the deficit button. So that's what I'm going to leave it at that. That's what we've got in the markets today. See how I intertwined all that? It's all one big piece of information. This is just info. These are symptoms of a problem. These are all symptoms of a larger problem. And the problem is the design of the system, shortage of commodities. Those two things. The design of the system must be inflationary in order for it to survive. If commodities have a problem and there's a shortage in commodities, it will be highly inflationary based off the design of the system. The design of the system, if you try to walk inflation backwards, it basically dries up the liquidity and starts breaking things in the banking system. Now, the housing market is pretty strong. We're in the middle of that housing market, which will be inflationary if they bring interest rates back down. The Fed is backed into a corner. I've talked about this years ago in the Palisades video that I did, my first one. They're backed in a corner. What are they going to do? I don't know what they're going to do. They're going to have to manage outcomes. There's no solution to this problem. They're going to manage outcomes. That's all they can do. And when you manage an outcome, it's called a predicament. You're in a predicament where you cannot solve the problem. You have to manage outcomes. And they're either going to have to manage problems in a currency, problems in a banking system, problems in a treasury bond market, problems in all of these things, or an inflation problem. I don't know which one they're going to... History shows us that they're going to print money, save the banking system, save the bond market, and have a problem with inflation. That's what we've seen in the past. So what is going to protect you in an inflationary environment? Well, we can all look at the charts and see what people are accumulating. We have wave one, we're at the bottom of wave two, and wave three is coming. So we already know where the opportunities are. Commodities, energy, precious metals, all these different things. If you guys need help with anything, definitely subscribe to the website, and I can show you companies that you can partake in or not. It's up to you. You have to make the decision yourself, but I can show you what I think are some of the best opportunities in the market. Flat out, bar none, period. Does it mean that they're going to work in the short period? Does not mean that they're going to work in the short period. These are long-term, big outlook pictures where when they go to reflate this, they're going to go ballistic to the upside. That's my opinion. Short term, though, it's going to be volatile. Get ready for it. We're going to be moving up and down, sideways, all over the place. But that's what I've got for today, guys. We'll see you at the Sunday Platinum Question and Answer session at 5 p.m. Mountain Standard Time. I'll see you there. And we can talk about all of this stuff. We can talk about your fears. We can talk about what people are fearful of. I think it's going to be one heck of a great discussion with a bunch of different questions because you guys asked really good questions. The community is really getting strong. We're finding lots of different companies that to invest in that range from energy service to energy to precious metals to royalty companies to all of those things. And we've got all the tools to be successful. Those tools are ratios, understanding the market conditions, understanding the psychology of humans. You know, think of this of what could potentially come. All right, you're going to have this chain of events that I've described before. We could see a bank failure, which causes more bank failures or bank runs, and that money comes out of the system and has to go somewhere. Where is that money going to go? We already know the answer to some extent because we've been looking at the charts. We're seeing where things are being accumulated and where the Livermore cylinders are showing up. The money will eventually get there. Or physical precious metals, or some of these other assets that we're seeing. But that's what I've got for today, guys. Hopefully you're doing all right. Give me a thumb up, subscribe to the channel, and we'll catch you next time. This is Finding Value.